Hey traders, welcome to Charts and Coffee. Hope everyone's having a good morning. We're taking a look at the indices to kick off the morning. And as always, if you have any questions, feel free to type them in. Phone lines are open for your request. So we're taking a look at some daily time frames, and we're taking a look at where we are in relation to the previous session close as sort of the first sentiment read on the morning. What are the two most important things I'm looking for every morning? Sentiment and trend. Where are we in terms of a bullish or bearish line in the sand? And then where are we in terms of the underlying trend of that time frame? The S&P continues to be still in a neutral trend, and we're just below the previous session close. That if it holds into 930, will be marginally bearish. But when we're right at that level, not significantly above, not significantly below, it doesn't take much to run stops and move above or below that line. So keep in mind, it's not really firm footing either direction. Be cautious. Directional bias is not clear. When I take a look at the NASDAQ, it's a little bit above. Again, not a lot, about a quarter point above the previous session close. So a little bit more clarity to the upside. And if the NASDAQ has clarity to the upside and the Dow has clarity to, as you can see here, the downside. So for as much as the NASDAQ's up about a quarter point, the Dow's down about a quarter point. Avoid the S&P, right? Avoid the S&P, because the S&P is going to get caught up in that tug of war between the two. That just simply means, and this is where it's interesting and sometimes misplaced, is this sort of really laser-like, almost obsessive focus about the S&P in modern markets. There are four indices, and they can do their own thing, meaning the way that each one of them are weighted and the concentration of different types of stocks is actually different, markedly different between the four of them. The Russell being, the one that's completely different. Dow is much more financials, say, healthcare, energy, industrials heavy. NAS, of course, is tech. S&P is a little tech. It's a little financials. It's a little bit more tech. It's a little bit of healthcare and energy. So it ends up kind of being a little bit like the NASDAQ and a little bit like the Dow, which means if there's not clarity in both the Dow and the NAS, especially if they're seemingly moving in different directions, the S&P is going to get caught up in the middle of that. So that's another thing we want to keep in mind. So let's jump on over to the S&P. Who is it moving with today? And you can see it's down a little bit, but not down as much as the Dow. It's not up, right? So you can see how the NASDAQ's keeping it afloat a little bit, and the Dow is dragging it down. This is what I mean. Until we've got clarity on very specific corners of the S&P, again, tech, financials, healthcare, and even energy, it's difficult to say that, it's the best way to take advantage of risk appetite or risk aversion any given day. And then, of course, we'll take a look at the Russell, which absolutely took off yesterday. The Russell was on its own little journey. And then once the 945 PMI data came out, we got our flash manufacturing, flash services data, which was a quote unquote miss, closer to that 50 than traders or investors would have liked. Up we went. And if you want a little bit more detail on yesterday, if you want a little bit more detail on how we can measure sentiment, check out the free video from yesterday. And you'll see that I walked through in a really specific and specific to tools and specific to process way of how I handle every morning. So if you want to know, okay, Rag, how are you going to handle the morning, like this, check out that video and you'll see how it is we do that in the Sector Secrets Mastery. So you'll see the Russell is down on the previous session close. The Dow is down on the previous session close. The S&P is a little bit down. And the reason it's holding as well as it is that the NASDAQ is a little bit up, right? So not dramatically mixed markets, but and perhaps there's some influence from Tesla this morning. Elon pulled a rabbit out of his hat, and Tesla sits at 161 right now. Now, remember, Tesla is heavily weighted not only within the NASDAQ, but also within the XLY ETF. And this is where Amazon resides. So we'll see if that move alone is going to be a rising tide in that corner of the NAS. Again, consumer discretionary. All right. So what else do we have going on here this morning? I'm taking a look at gold here. Moving higher. There we go. Gold moving a little bit higher. Not much, but you can see on an intraday time frame. Let me show you that right there. 5-minute time frame, short term. Recently, as of the last 30 minutes, gold's had a pretty nice surge. And that just begs the question, what happened in the last 30 minutes that might have changed hearts and minds? And if I take a look at the Wednesday, April 24 list, would core durable goods orders be a major economic event for the indices? No, it's not a red hot zone. It's not a major hot zone, but it is something that we'll keep an eye on. So gold's moving higher, but have we had any specific moves intraday on the indices as of that 8:30 hot zone? So go back to the 5-minute chart. Right? We never want to guess at it. We just want to take a look at whether or not there was a reaction. And indeed there was, right? So not normally would I consider something like the core durable goods to be a market mover, but it's on the calendar. We know it's a scheduled, potentially high impact event. I don't want to presume that every non-farm payroll is going to be a big one. I don't know that every say core durable good is going to be a small one. If there's the potential to move the market. Now, am I expecting the PCE on Friday to be a major market mover? Absolutely, but it doesn't have to be, right? There doesn't have to be a move in the PCE that is a significant volatility event in the indices or gold or bonds, but I would expect it to be. So don't be surprised when we have, say, a medium impact hot zone that's able to do this. You might say, Rag, is this the hot zone? Yeah, take a look. 8:30, there's your wiki response, wick to the upside, wick to the downside. And ultimately, a lot of the weakness this morning is coming from that 8:30 core durable goods. Now, yes, there might have been something else happening at the same time. I am curious. Let's see. Core durable goods. Nope. Seems to be the core durable goods at 8:30. So there's your reaction. And, this is a lot like yesterday's flash manufacturing services number, where there's the potential for significant movement. And indeed, it triggered it. So keep an eye on that economic calendar, because you never know. You never know what hot zone is going to be able to move the market, but we know it's scheduled. We know it's on the calendar. We know what time it is. And that's going to help us time the reaction. So I'm not interested. If you noticed, I actually don't know what the number was. I actually don't care. I'm more looking at the reaction in indices and in bonds. Core durable goods orders. There you go. 0.2 versus 0.3. The previous was revised lower from 0.5. All right. So here's the hilarity of these numbers. Sometimes we are reacting to numbers that aren't even right. Right? So sometimes we're reacting to. So for example, the last core durable goods came in at 0.5 and we reacted to 0.5. And then the next release, they say, whoops, the previous was, overestimated by 0.2. Who knows? It's the hilarity of data, but yet we have to react to it, or at least watch the reaction to it, see what happens. But core durable goods came in a little cooler than expected. What does that mean? That would fall a little bit more into the inflation metric. But nonetheless, rather than go round and round about what 0.2 means versus 0.3 versus a revision, I'll leave that to the geniuses on television. We'll just go ahead and take a look at the reaction on the screen, and we can see it is bearish to equities for now. All right, so let's see what else we've got here. Looks like the NAS is coming down a little bit, but as long as it remains above 17,656.5, it's still up. It's still in sort of this bullish hemisphere. It's still in the bullish sentiment side of things. So if I take a look now at then the ES, it's got the Dow weakness, it's got the S&P relative strength, And where is the ES? Look at how it's just barely, it's might as well be break even. It's got to be above or below, but it's 0.04. And so you can see there, very negligible amount in the bearish hemisphere. It's really because NAS is lower, and then look at the Dow. So for as much as the NAS is up, nearly the Dow is down. That's where the S&P is stuck in the middle. All right, let's go take a look at, let's take a look at the VIX this morning. So I talked quite a bit about the VIX over the past few weeks, and that's because since the 4th of April, we broke the range high that we had been in for all of 2024 and some of 2023 Q4. We broke that for really only the second time this year. The first time was mid-February, the second time here early April. Now, unlike the early April break of the 16 high on the VIX, again, we take a look at the normal range, and 16 was for this year the high. Not anymore, but it was. So we break it on the 4th. We stay above it on the 5th. Now, this is markedly different than the last time we would have broken this level, because when we did it in mid-February, we spiked up through it. We came right back down into the range. Here we went up through it, stayed up through it, stayed at it, stayed at it, stayed at it, and then boom, on the 12th, we really started to see increased volatility. Well, so this is where the misinterpretation of the VIX happens so often. The VIX up or the VIX down on any given day really isn't important to longer term 1 hour daily assessment. Volatility in general is not about whether or not the VIX is up or down. Volatility really is, where is the VIX in terms of its normal operating range? So an up day above 16, incredibly volatile. A down day above 16, still incredibly volatile. We know that we had a very down day on the 22nd, but we are still above 16, still volatile. If we're going to see trends and normal price movement ranges, our historical volatility ranges, back in their 68% probability, we're going to have to get below and stay below 16. And these are the first 2 days that we have seen since, these are first 2 days that we have seen since the 12th, where this is actually happening. And if you're wondering, what was the big deal? Why did the S&P do what it did yesterday? VIX below 16, S&P above its anchored VWAP for the year. You start stacking these different reasons together, and all of a sudden we see where follow through can come. Now, it'll be really important to continue to make higher highs and higher lows to pull the S&P out of this somewhat bearish chop, but it is chop, right? The S&P is in chop. Let's not treat it like a downtrend, because it really isn't. And as long as we're seeing the kind of movement we're seeing to the upside, I would probably consider a little bit more bullish a take on the S&P, but a lot of that's going to depend on whether or not we can get above that previous session close or whether we'll stay below it. So that means if I'm going to be day trading this morning, I'm going to focus on bearish setups on the Russell and on the Dow being clearly below the previous session close. There's some other metrics we'll look at. There's some other lines in the sand, if you will, that we'll look at, not just the previous session close. But right now, the Dow and the Russell would be really good candidates for downside movement, while the NASDAQ would be the only index for upside movement here this morning. So if I take a look at the NAS, as long as it can stay above 7656.5, this will be likely a bullish take. Then we start to look at the sectors. And one of the sectors I'm very interested in this morning is going to be financials. This could be tricky because the Dow is heavy, and XLF financials are the number one weighted sector in the Dow. I know, Dow Industrial Average with financials being number one weighted, that's the world we live in. So if I take a look at what's happening on the XLF right now, it's not going in the direction that I want, but it's not significantly below where we closed yesterday either. So a little heavier than I'd like, but I'd like to see that start to organize. What about energy? Energy a little heavier than I'd like, which is fine. We still have Exxon and Chevron earnings to come, so it makes sense to be patient with this particular corner of the market with earnings coming up. What about XME? This has been a sector we've been very interested in for a while, XME and XLB, and relatedly, although it may not seem so on the surface, copper. So basic materials, mining and metals, and copper will have a lot in common, and probably the connective thread of those three, what seem to be disparate markets, is Freeport-McMoRan. Freeport-McMoRan is weighted heavily in the XLB, weighted heavily in the XME, and Freeport-McMoRan tends to move a lot like copper. So it had earnings yesterday. I tend to want to leave a very fresh earnings response alone, and then today we'll look to see if there's an opportunity to get long Freeport-McMoRan, which is something we've done on and off for many months now, especially since the metals and mining sector has been such a relative outperformer, and it continues to be. That, as well as gold miners, continue to be very strong in this environment. So where semiconductors and communications used to reside in terms of being at the top of the food chain, the top of that relative outperformance, now we see gold miners, metals and mining, gold, silver, copper, all near the top, crude oil, XLE, energy, XOP, oil and gas explorers up near the top. So very different look at the rankings, if you will, right? When we take a look at who's going to make the playoffs. Yeah, we're definitely looking at a very different group of sectors than we did in Q1. And that just reminds us that just because something was working, just because that's something that worked in the past, doesn't mean it's going to continue to work in the future. And the hardest thing to do is let go of something that you loved trading, that worked for a period of time. But if it isn't working anymore, you got to cut it loose. And that's where conversations like, gosh, could Newmont Mining and Barrick Gold and Freeport-McMoRan, sit in terms of interest where things like NVIDIA sat once upon a time, right? Or even Meta sat once upon a time, and not that XLC is not still strong, but the way in which we looked at NVIDIA and Meta, say in Q1, is and even Amazon is the way that I would look at Newmont Mining and Barrick Gold and Freeport-McMoRan in Q2. What a different set of symbols. And if you're having struggles, Rag, okay, this is interesting. I've watched you in Charts and Coffee for months, if not at this point for years. If this is looking interesting, come check out what we're doing in the Sector Secrets Mastery. We do this every day at sectorsecrets.com. You can check out what we're doing. Everything from the newsletter you get from me every Monday to watch list building to a number of tools. This is what we do. We carry this conversation from Charts and Coffee right into the live market, right after the bell, and we look for opportunities. Day trading is coming back. We've had actually a pretty good week so far of day trades, not without its challenges, but we've actually had a pretty good week of day trades. We had some tech earlier this week, financials yesterday. So there are some really good setups that are coming into focus on the shorter term 5-minute time frame, which is something we focus on for the first hour every morning. And then we move on to looking at our swings. And like I said, we've got some interest in financials this morning. We'd love to see some follow through there. We've got some interest in metals and mining, like Freeport-McMoRan. Would like to see a setup there. So slowly but surely, as that VIX gets below and stays below 16, things should start to begin to behave in a way that will allow us to manage risk and allow us to find follow through. And both those things are important, and frankly, in that order. And those are things that frankly haven't been as prevalent these last 3 weeks. They've been frustrating weeks. I'll be the first to say it. And not every environment is going to be ideal for account growth. If we can get back down below 16, get those trends residing, whether it was SMH and NASDAQ names and financial names in Q4 of 2023 and Q1 of 2023 and 2024, or whether it's now miners and metals and energy in Q2, I don't care. As long as we can find a trend, we can get that follow through. Be good to each other, gang. I'll see you tomorrow.